Hi guys, I'm Manu and welcome to another episode of Sweet Money. As for myself, I'm a CPA from Canada and the US and I own a cool little accounting firm. For those of you who have money, we're going to talk about 3 cool little tax havens that you should be using to defer taxes or minimize your taxes. And for those of you who aren't there yet, hopefully these 3 tools will encourage you to go out there, go into beast mode, and generate generational wealth. So let's get into it. Before we begin, someone in the comments section had requested for this topic. So first of all, thank you to that person for watching and commenting. So based on your request, here it is, and I hope you enjoy it. And for the rest of you, if there's any topic you would like me to cover, please feel free to put in the comments section and I will put it in the rotation of my list of topics. And for those of you that are new, please don't forget to give me some SLC. SLC is subscribe, like, and comment. Let's first define the difference between rich and wealthy. Now, this is my boy Chris Rock's definition. And I gotta confess, no CPA or no dictionary can provide a better definition. I'm going to paraphrase because he had a few swear words in there. His definition, Chris Rock's definition, is the person who signs the NBA player's check is rich. The player who dribbles the ball up and down that basketball court is wealthy. Today, we're going to talk about the wealthy because these programs apply to wealthy individuals. The rich have their own set of rules. Now, you might be wondering who falls in this wealthy category. And these people are artists, athletes, surgeons, entrepreneurs. You get the drift. Now, these 3 programs known as IFA, IPP, and RCA, they apply to wealthy individuals. And my definition of wealthy in Canada is if you earn over $300,000 per annum. And if you're earning more than that and your accountant has not poached you regarding these programs out there, you've got to ask yourself some tough questions. IPP, Individual Pension Plan. Let's take a very simple example. A dentist earns $400,000 a year. The dentist requires $200,000 in order to make ends meet. The dentist owns a corporation. Now, he's taken out $200,000 through payroll. Now there's $200,000 left in the corporation. What keeps a lot of entrepreneurs and high-paid professionals up at night is how do I extract my cash from my corporation by paying little to no taxes? Now, the IPP is designed for individuals, whether they own a corporation as an entrepreneur, a CCPC, or whether they have a service corporation, such as a dentist or a doctor or an artist. Now, in this case, these are tools to help further reduce your tax, and it's allowable as per the Income Tax Act. Think of the IPP as an RRSP program on steroids. Now, under normal circumstances, a dentist can invest a maximum of 32 Gs in the RRSP program. But the IPP program allows you to invest a lot more than $32,000 in your pension fund. And in some cases, I've seen people double that $32,000 and go up to $65,000, a saving of $30,000 in taxes. So in essence, an IPP allows for a higher tax deduction contribution amount in comparison to your RRSP contribution. And wealthy individuals who wish to maintain their pre-retirement lifestyles can do so by investing in these tax-deferred shelters. In the past, I've heavily preached the benefits of putting yourself on payroll. This is another reason why you need to be on payroll, because in order to qualify for an IPP, the individual pension plan, you have to be on payroll. And that's one of the prerequisites. Now, here are 10 facts about the IPP program. Substantially higher retirement savings compared to an RRSP. Program is for those who are 40 and above. IPP investments grow on a tax-deferred basis. Funds in an IPP are protected from creditors. IPP and its related expenses are 100% tax deductible. It might be possible to make retroactive payments. Additional lump sum contributions are allowed at retirement. Income can be split with partner as a way to reduce taxes. At death, IPP can be transferred to spouse tax-free. Several options of how to extract cash during retirement are available. Disclaimer: all tools are not suitable for everyone. Therefore, if you consider yourself to be in the wealthy category, please book a consultation with myself. The link to my website is down below, and we'll figure out what works best for you and your situation. RCA, Retirement Compensation Arrangement. The RCA are used by individuals who are athletes, celebrities, or executives who get paid large bonuses. Now, let me give you a real life example in which if I was their accountant, I would have suggested the RCA. Whether or not they got the RCA, I don't know, but I would have recommended it to them. Let's get into it. Leon Draisaitl is a hockey player for the Edmonton Oilers. He recently signed a contract for $112 million to be paid out over 8 years. In the first year of his contract, he gets $1 million salary and he gets a $15.5 million signing bonus. Cool? So far, so good. Now, if I was Homeboy's accountant, I would have suggested you make ends meet off your $1 million salary. It might be tough, but we'll try. And that $15.5 million signing bonus that you're going to get, let's put that in an RCA. Now, if he doesn't put the $15.5 million in an RCA, what happens? 52% of it goes to taxes. He loses half that bonus. He'll never see it again. Or if he ends up putting that $15.5 million in an RCA, he will get taxed on the amount after he retires. Now, an athlete has a shelf life till about their late 30s or early 40s. Because Leon Draisaitl is a superstar, barring any injuries, he should go till his late 30s, early 40s, because he's very talented. And if he retires at 40, he has at least 45, 50 years ahead of him in which he will not earn this kind of money. So he has to now make his savings last him 40, 45 years. A $15.5 million can now be spread out over 40, 45, 50 years. And on top of that, he can split that income with his wife. Leon Draisaitl is married. So if he remains married, he can split that income. So now what he's done, he's peanut buttered his signing bonus and he split it with his spouse, which will drastically reduce his taxes. And on top of that, he has guaranteed income during his retirement years. And Leon, if you're listening, this tax consulting invoice is in the mail. So if your compensation pays you large sums of money in one shot, kind of like how celebrities get, a few $1 million when they go on tour. They might not need all of it, so they can defer it to an RCA. A-list actors, they get $15, $20 million as signing bonuses when they sign up for a movie. Now, they don't need the whole $15, $20 million. They can put it into an RCA and defer it. Executives, same thing. So if you fall into these categories and you're not taking advantage of the RCA program, the Retirement Compensation Arrangement, you need to reach out to me. IFA, Immediate Financing Arrangement. This product is very convoluted and will most likely leave more questions than answers. Therefore, please feel free to leave your questions in the comment section and I will get back to them. An IFA is good if you meet these 3 criterias, okay? And the 3 criterias are, you want to leave a large sum of money for your children and loved ones or your spouse. Number 2, you have a lot of money sitting in your corporation and you want to extract that tax-free. Yes, I said tax-free. And by a lot of money, I mean $1 million plus, okay? Number 3, you have confidence in your entrepreneurial skill set and you believe that if you were to get a loan, you can take that loan and generate more money than what the interest rate would be, okay? Now, if you tick off all 3 of these, you're heading down the right direction. In addition, you have to have a healthy balance sheet. Now, a healthy balance sheet means different things to different people, but your accountant and the banks will determine whether or not your balance sheet is healthy enough for the amount of money that you want to extract every year and put into the insurance program, and whether the loan that the bank is going to give you, whether they feel comfortable that you have the ability to pay off that loan. Okay, so let me now explain what all this means. You are an entrepreneur. You have over $1 million sitting in your corporation that's idle. Okay, and you want to extract that money. That's every entrepreneur's headache. How do I extract my cash from my corporation? So what are you going to do? You are going to get a whole life insurance policy. Okay, this whole life insurance policy has to be a minimum of 10 years. So you got to pay the premiums for 10 years. The premium has to be a minimum of $50,000, which means you have to commit to paying a minimum of $500,000 over the next 10 years for this insurance policy. Now, for those of you who have a whole life insurance policy, you can imagine how big the payout would be if it was $50,000 over 10 years, right? So you can just imagine that for yourself. But like I said, it's for the wealthy. What happens now is you have extracted $50,000 from your corporation. So the money comes, so it's after tax dollars. Through your CDA, you pay this premium. Okay. So now the banks come in and they say, okay, you have this insurance policy, which we will use as collateral. Now, because you put $50,000 in this insurance policy, we will loan you, and we being the banks, we will loan you $50,000. Now, you probably know a loan in Canada is tax-free. In addition, when you get a loan, you can use that money for whatever you want, which is why I said one of the criteria is, are you a savvy entrepreneur who could take that $50,000 and grow it? And the reason why it's important to grow it, because you're getting a loan, and loan has an interest component to it. The interest rates are coming down. I think right now you can get a loan for 5%, and it's going to go down with time. If you feel you can beat a 5% interest rate, then this is great for you. Okay. Now, in addition, the interest that you pay is tax deductible, right? So that interest in essence isn't 5%, it's 4.5%, because the CCPC's small business tax rate is 12%. Therefore, in essence, that interest rate is really 4.5%. Okay. So that's another advantage. Here's the banger. This is the kicker. If you don't want to pay the interest, you just want to take that $50,000 loan and put it as a down payment on that Lamborghini, go ahead and do it. You are not required in the IFA program to pay off the interest or the loan if you don't want to. Because like I said in the very beginning, the insurance policy is the collateral. So if you don't pay off that loan, you don't pay off the interest, it's okay. But if you go into beast mode, and you take this tax-free money and you can invest it and grow it exponentially, this is an amazing tool, because several things have happened. You've extracted cash from your corporation. You now have an insurance policy for your loved ones. Because you're going to grow that money, you can now afford to pay off the interest, which is a tax benefit. And if you can do even better than beast mode and quadruple that money, you can also pay off that loan. And if you pay off that loan, just think, how much money are you leaving behind for your loved ones, or for a charity, or for anything you want? If it's used by the right person for the right thing, it can be a game changer. This tool is not for everyone. There are risks and there are pitfalls. It is very important that you know the pros and cons of this tool. For example, the past couple of years, the interest rate was very high. There was a time when loans were being given out at 7-8%, and the market was not doing well. Housing market was not doing well. The financial markets were not doing well. So whoever had an IFA program 2 years ago, it would have been very hard to get a return over 7 or 8%. And this is a risk, one of the risks you have to be willing to take over a course of 10 years. So guys, I've thrown a lot at you, but the ultimate goal is to determine what works best for you. And remember, it all starts with a simple conversation.